I now hand the conference over to Mr. Anup Pujari of CDR India. Thank you, and over to you, sir.
Thank you. Good morning, everyone, and thank you for joining us on Max Healthcare's Q4 and FY 2021 earnings conference call. We have with us Mr. Abhay Soi, Chairman and Managing Director of the company, Mr. Yogesh Sareen, Senior Director and Chief Financial Officer, and Mr. Dilip Bidani, Senior Director of Finance of the company. We'll begin the call with opening remarks from the management, following which we have the forum open for an interactive question and answer session. Before we start, I would like to point out that some statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings presentation shared with you earlier. I would now like to invite Abhay to make his opening remarks.
Good morning, all. I hope you and your family have kept safe in these challenging times. It gives me great pleasure to welcome you to the fourth quarter earnings call for Max Healthcare for the financial year 2021. Let me give you the key highlights of this quarter before opening it up for Q&A. Starting with the COVID update, we continue to be at the forefront in the fight against COVID through our network of hospitals in 6 states. We have already treated over 32,000 COVID patients at our hospitals. In addition, 3,500 patients at their homes and extended COVID facilities. We also conducted around 5.5 lakh RT-PCR tests. Compared to the first wave, we see that the second wave saw an increased number of hospitalizations, leading to impact on non-COVID admissions towards the end of March. COVID admissions peaked at 2,100, leading to extremely high overall occupancy, which is expected to compensate for lower ARPOB. In addition, we commenced our vaccination drive for 18+ on the 1st of May. Currently, we have ramped up our capacity to administer 50,000 vaccines per day. This includes on-site as well as off-site camps for leading corporates. We are running one of the largest vaccination centers in the country with the capacity to administer as many as 10,000 vaccines per day. So far, we have already administered over 5 lakh doses and were constrained by vaccine availability thus far, which we believe shall improve over the next few days itself. We continue to focus on clinical excellence, and I'm proud of the achievements of our doctors and support staff. During the course of the pandemic and over the last quarter alone, our doctors have published 116 national and international publications. We have also conducted 11 studies and trials on COVID indications and 70 non-COVID clinical trials during the fourth quarter of FY21. Most importantly, we continue to serve patients from the economically weaker sections of the society. In the past quarter alone, we have treated around 990 inpatients and over 39,000 OPD patients free of charge. Now coming to the financials, we are pleased with the results despite COVID-related constraints. This quarter was also marked by a successful completion of our equity fundraise of 1,200 crores through a QIP, leading to addition of some marquee domestic and international investors to our list of shareholders. In the fourth quarter, 20% of bed capacity was reserved for COVID patients, while the occupancies on these beds dropped to 35%, those for non-COVID were almost 80%. This quarter, occupancy was also marred by the farmer strike in and around Delhi NCR. Overall occupancy in the fourth quarter FY21 decreased to 70% from average of 76% in the third quarter FY21. However, drop in COVID occupancy enabled ramp up in higher ARPOB. As a result, our ARPOB increased to almost 57,000 in quarter 4 compared to 51,000 in quarter 3. Further, medical tourism also showed signs of recovery during the initial part of the quarter and had returned to 60% of pre-COVID levels prior to the second wave. However, starting later part of March, there was an uptick in COVID cases, which once again led to increase in occupancy, while overall ARPOB was sustained at January-February average. Gross revenue for the quarter stood at 1,159 crores, a growth of 5% year-on-year, and same levels as that of the third quarter FY21. We achieved an EBITDA of rupees 263 crores for the fourth quarter, a growth of 68% year-on-year and 4% quarter-on-quarter. The network also reported a significant improvement in operating EBITDA margin, which stood at 24.1% for the quarter, up from 15.5% in the corresponding quarter in FY20 and 23.2% in the third quarter FY21. Significantly, the operating EBITDA improved over the third quarter FY21 despite the reinstatement of COVID-related transitory cost cuts. Further, the company generated over 140 crores in operating cash flows post capex and interest costs, which was used to repay down debt. During the quarter, consequent to the successful completion of equity fundraise of 1,200 crores through the QIP, the company's net debt, including put option liabilities, improved significantly. Net debt as at end of March 31, 21 stood at 544 crores as against 1,867 crores on December 31, 2020. Net debt to EBITDA ratio is thus below 1. For the full year, the gross revenue degrew by 12% and stood at 3,861 crores, mainly due to the first half drop of 29%, while in H2 we grew revenues by 8%. Lower revenues in the first half of the year were attributed to countrywide lockdown and the state of pandemic. Most significantly, we are happy to report, despite lower revenues, the network operating EBITDA grew by 8% and stood at 636 crores. The operating margin for the year was 17.5%, an increase of 287 basis points over FY20. We have implemented rupees 108 crores worth of structural cost savings, which are permanent in nature during FY21. Of this, 73 crores has reflected in EBITDA for the year, while the fourth quarter Q4 of the previous year results reflect the full impact of all of these initiatives. While in the past fiscal year we have dealt with a complex merger listing structural cost saving program and have been at the forefront of battling COVID, we have also parallelly been laying ground for immense growth in years to come, whether by way of building clinical programs or growing our digital platform and asset-light adjacencies, raising funds to reduce our net debt and build capital reserves for pursuing future organic as well as inorganic growth opportunities. Going forward, we plan to continue focus on optimizing capacity utilization in our existing facilities and resources, increasing our ARPOB, optimizing patient mix, brownfield expansion on existing land banks, scaling up our capital-light adjacencies like Max Lab and Max at Home, and opportunistically looking at merger and acquisition opportunities. In line with our strategy to unlock value in retail pathology business, the company plans to incorporate a wholly owned subsidiary for our non-captive pathology business, Max Lab. We would also commence our brownfield projects and construction in the first half of the current year. We are cautiously optimistic on the growth path in this quarter and ahead. On this note, now I wish to open it up for Q&A. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask questions, please press star and 1. The first question is from the line of Shaleen Kumar from UBS. Please go ahead.
Congratulations to the management for a good set of numbers. Abhay, if you can talk about economics of this vaccine, like any sense, how should we model that in? And what do you think could be so obviously you talked about that you can do 10,000 vaccine per day, but what's the opportunity size for according to you? What are you assessing? Any broad maths around that?
So our current capacity is 50,000 vaccines a day. one of our centers is doing, the largest one, can go up to 10,000 a day, but presently we are doing close to 50,000 vaccines a day. So that's one. Secondly, these are positive opportunities from both from a cash flow and a profitability standpoint, simply because the private healthcare sector is permitted to charge what it wishes. On the back of this opportunity, you also have tremendous amount of consults, antibody tests, and so on and so forth, leading not only to newer customers but even other positive cash flow streams. The size of this opportunity, I believe, is immense. It is only constrained by the number of vaccines which have been available. In the month of May, it was challenging. We had a reasonable allocation, but it was challenging for the sector and the country as a whole. This situation is expected to improve, like I said, over the next few days. One indication of the opportunity size is that in spite of the number of government centers which have opened for vaccinations, as well as centers opened by the private sector, you will see appointments on CoWIN app. When you open appointments on the CoWIN app, they go away in a matter of seconds, 4 to 6 seconds, literally for all your appointments to go away, whether you open it up for a week or a month. So I hope in some measure, I have been able to answer your question.
Thank you. We move to the next question. The next question is from the line of Damayanti Kerai from HSBC Securities and Capital Markets. Please go ahead.
Hi, good morning, and thank you for the opportunity. Abhay, can you provide us how has been progress on patient footfalls in your key NCR hospital? Whether the patient volume is primarily driven by the local patient, or we are seeing good volume coming from outstation patient also, and how do you see patient volume growth over next few quarters?
Basically, I think we already mentioned that we had some effect on the upcountry and that since it was farmer strike and the COVID situation, there was a drop in the. But otherwise, now it depends on specialty. We can't really talk hospital here. It's a specialty driven footfall. So if it's liver, then we get footfall from even 500 km away. So if it is organ and gynae, then you get footfall from 10 km radius of the hospital. So I would say more or less there was some impact on the volume footfalls because of the COVID situation. But I think in March it improved, and that's also been seen in the occupancy. You've seen the occupancy in March was 75%, right? So yes, I would say some impact, but we recovered that in March, and hopefully when the COVID wanes, as we see today, the numbers will bounce back.
I think in addition, even international had only come back to 60% of it. Over the past 1 year, we have not been able to, as an organization, stand tall and show our entire strength because we have been limited and constrained by COVID. But with this vaccination drive, hopefully, we'll be able to get past any further waves, etc. And we should see normalization hopefully over the next few quarters.
Okay. In normal situation, international patients are around 10 to 12% of our hospital revenues, right? Which is yet to come back.
That's right. Yeah. Come back only 60% in Q4.
So both OPDs, only OPDs have been operating at lower than pre-COVID levels because obviously footfalls are lesser people during COVID times or space times back. So those are two come back, international as well as OPDs.
Okay, that's helpful. And my second question is on ARPOB. So in terms of ARPOB, we have seen a very good, very strong pickup in fourth quarter. And if we look at the year also, year-end full year numbers, it's much higher than some of your peers. So my question is what kind of headroom you see in ARPOB growth, and what will be the key drivers for the growth?
So I think clearly one is international, which is extremely high ARPOB business. That is the key driver. Secondly, OPDs. The OPD revenue is essentially, sort of spread over the entire denominator of total number of beds that you have. So these two aspects should immediately give you some sort of increase in uptake in ARPOB. These are two aspects. I think other than that, what we've seen is a huge proliferation of insurance during this period. That is again something which is going to be providing you an uptick in ARPOB going forward. The clinical mix improving again is something. But I think most importantly, like we had mentioned in the past, inordinate amount of our business, 35% of our total beds were occupied by the government business, which is CGHS, ECHS, etc., which is extremely low ARPOB, and our intention was to bring this down to about less than 15% of our total revenue. That is a big opportunity for ARPOB increase. So as you see the preferred business, which is cash, insurance, and international, grow organically within the system, and there are enough and more indications why it should. Insurance, because of proliferation of insurance, I think as far as international is concerned, yet to come back. OPD is yet to come back. So all of these things will be bound well and bear well for your ARPOB, certainly.
About good growth over this 51,000 annual ARPOB which we are having right now.
No, so I think pre-COVID levels, our ARPOB was higher than that. So we're talking 57,000. In quarter was 57,000 ARPOB, not 51,000. At the same time last year, I think was 53 or 54,000, if I'm not mistaken. So you should see it going higher. But you also have to keep in mind that most of our hospitals are in the metros, which lend to higher or better clinical talent, as well as our ability to drive higher end quaternary care programs, which lead to better ARPOBs.
Okay, that's helpful again. My final question is, how many beds across your network are currently allocated for COVID patients, and what is the occupancy right now?
So you're talking of March, or you're talking now?
Current status, sir.
Yeah, so currently we have around 1,200 patients in the system for COVID. And we have roughly 60% of the capacity being allocated to COVID beds.
But it's quite dynamic in the sense that as COVID goes, we start moving capacity to non-COVID. It's not out of regulation or whatever. It is more because you have the patients.
Okay, just to clarify, right now around 1,200 bed for a COVID patient, right?
Right. Yeah.
Okay. Thank you for your response. I'll get back in the queue. All the best.
Thank you. The next question is from the line of Thomas Priju from Alchemy Capital. Please go ahead.
Thank you. I have a couple of questions. The first is, you all indicated that most of the cost-saving initiatives have been implemented. From that perspective, should we consider Q4 margins as more or less optimal margins from an EBITDA perspective? And also, when you deploy the money you have raised through the QIP, is there a risk that in the new capacity which comes on stream, which will take some time for the margins to scale up, and hence a year or two down the line, we may not see the margins we saw in this quarter? That was the first question. The second is, you mentioned the capacity you have is on the vaccine side is 50,000. What is it that you are doing at this point in time? What exactly are you doing at this point in time? And assume if things work out well for you, that optimal capacity of 50,000 you can run at that rate for how long? For the entire FY22, or are you seeing an opportunity in 23 also? And lastly, in this business, because there will be vaccines will be selling in a broad range of prices, is it fair to assume that final profit which can accrue to you post your cost can be on an average around 200 per dose? Thank you.
So let me answer your vaccine question first. We have ramped up our inoculation capacity since May 1 to about 50,000 as we speak. This number is only ramping up going forward. That's one. The constraint has been availability of vaccines, and we are doing close to that number that we have come up to. So we are doing 40 plus thousand, sometimes with 40 to 50,000 sort of range of vaccinations a day at present. So this is as far as the vaccination is concerned. As far as margins are concerned, there are different vaccines which will come into the market. As we speak, there is no cap on pricing of administering, but eventually the market will decide when there is adequate vaccines and adequate availability of adequate vaccines and different sorts of vaccines which are available. Sufficient to say that it will be positive because there is no sort of anybody's head to administer vaccines. Only if it is positive would people sort of vaccinate in the private sector. So it is going to be, what that number is going to be, will it get regulated tomorrow, will there be a capping, etc. We don't have I can't really forecast that. But in the absence of a government regulation, the availability of vaccine with players as well as the market dynamics will really decide the end price. The purchase price for all players is the same. So it's really your administering cost, your efficiency that you can bring in over there versus others, and the price, like I said, is going to be decided by the market. That's on the vaccine. As far as margins are concerned, cost savings is only one element of margins, which leads to these margins. Like I said, once your OPD numbers come back, your international business comes back, your other business comes back, that should bode well for your margins going forward as well. More importantly, the government business, which earns us 40%, almost 40% less for the same service that we provide in our beds compared to a CTI patient. When that number drops, when we reduce our government business in lieu of the preferred channels, which is CTI, you can imagine a 40% increase in pricing effectively for the same service, and about 85% of that flows into your EBITDA line, because 15% approximately goes to the doctors. So that is something which should help you expand your margins going forward further. Now, these are, of course, the things that I'm saying, considering all other things remaining static.
Sure. And the vaccine opportunity, you see a decent opportunity in 23 also, or primarily it will be a 22 opportunity?
So I think, look, you have to figure, we have to be reactive to this to some extent. In 23, if there is no pandemic, if there are home tests with and nasal, vaccines which come out, then inoculators, vaccinators, and hospitals will have less of a play over there. So it really depends, and there is a lot of that science which is perhaps being developed. When it comes out, one doesn't know. Right now, there is essentially a two-vaccine regime in India. Most people have not even been vaccinated the first time round. They're going to be vaccinated the second time round. There is talk of maybe perhaps you would require boosters going forward. So the opportunity can be endless from that standpoint, but at the same time, new technology, new solutions for the pandemic are coming, and that is the other aspect which will sort of curtail your. There are two sort of winds which are at crossroads to each other on this.
Fair enough. Thank you very much.
Thank you. The next question is from the line of Andre Purushottam from Cogito Advisors. Please go ahead.
Yeah, hi. This is Sangeeta, Andre's partner. Firstly, congratulations for a great performance. My question really was that, in FY22, what kind of volume drivers do you see, given that I think you're now operating close to peak capacity? So as the new capacity is likely to ramp up in the subsequent years, how do you see the outlook for this particular year? And the second question is that while your net debt has come down, as your capex picks up, do you expect this to go up again? or it will get funded from the incremental cash flows that you're going to generate this year and in subsequent years?
We are generating, as far as net debt is concerned, it's at a fairly low level. We are generating, last quarter itself, we generated 140 crores plus, free cash flows, which we use to repay down this debt. Going forward, our interest cost has come down significantly. That will add to, the free cash flows available to pay down debt. So you should have about 200 plus crores, almost 200 crores per quarter, effectively 175 to 200 crores per quarter, that you can use to repay or pay down debt. And that would essentially take you to a zero debt company, but that's not necessarily where the thought process is. We will be using our cash flows for brownfield projects. We have about 1,400 crores over the next 4 to 5 years. In addition, it gives us an ability to leverage up because we won't have any leverage, and which we are going to be using for inorganic growth. So this is as far as the balance sheet and debt is concerned. What are the volume drivers for the next quarter? Yes. So the volume drivers, firstly, if you look at the Q4 results, vis-a-vis Q3, our occupancy, these results are better, but the occupancy from 76% has come down to 70% for the quarter. You see some of the occupancy levels that we've been operating at, 80% and 80% plus in the Q1 and I think of this year, and that is perhaps what you'll see in the presentation. More importantly, it's not only volume and this thing, and like I pointed out in the previous question, that 35% of our beds are occupied by government business, which leads us to less revenues and ability to generate from those beds. And once we substitute that with the government, that's where the huge opportunity is. I mean, you can actually look at the business as occupancy of 70 beds, or you can look at it as occupancy of 50 beds with preferred business, and 20% is sort of just marginal business which is sitting over there, which you want to displace. So you have an opportunity to move from 50 to 75, 80%, right?
Right. And you think that's likely to happen over this year, or it's going to take you a couple of years to do that, to sort of unwind the government business?
No, so we said over 3 years, from 35%, bring it down to 15%.
Okay.
So we are about 6 months into that conversation. So another 2.5 years, we should be bringing it down to 15%. It's a gradual process. It's not going to happen overnight because there is a particular rate at which your preferred business is going to grow.
And how much are you going to be investing into the diagnostics business?
Diagnostics is not a very capital-intensive business. It doesn't require too much capital or almost any capital, to be honest. Maybe 15, 20 crores sort of this thing. But any investment in that business is going to be to fund acquisitions.
Right. Okay. All right. Thanks a lot and all the best.
Thank you.
Thank you. The next question is from the line of Amit Khetan from Laburnum Capital. Please go ahead.
So thank you for the opportunity. I have 2 questions, and it would be great if you can share a medium to longer term perspective on both. The first is on medical tourism. What is your goal or aspiration here in terms of where you want this to be as a share of your revenue? I understand that pre-COVID this was around 10 to 12%. And what steps are you taking to drive this?
So we see this, as a massive opportunity. We believe Max is not necessarily, we at Max and, high-end quaternary care hospitals in metros are not necessarily only the answer to India's healthcare problems, but global healthcare problems as well. Simply because of the sort of high skill sets which reside in our facilities, as well as the huge cost opportunity arbitrage which is there. We intended to set up a global direct-to-fly franchise, very similar to what some of the successful players in Thailand have been able to do. Obviously, with the ban on international flights, etc., our progress was sort of curtailed in doing so. We are setting up an office and a beachhead in Dubai to support our Middle East offices. We intend to do the same thing in Africa and other countries and so on, which will lead to direct-to-fly opportunities and increasing medical tourism. Now, when you ask me what is the opportunity set, I think it is limitless, effectively, because the competitive advantage we have as a nation, as a group, as a chain of hospitals, there is no other player in the world, I believe, which can really stand up to that. So we are essentially constrained only by our ability to get out there and get that sort of a this thing. Eventually, this is the highest ARPOB business. It is very high margins because people come to India to come to our facilities for only high-end quaternary care, not necessarily for simpler clinical solutions. So therefore, it's hard to say and have any sort of objective in terms of what percentage of our revenues will come from medical tourism, but we believe it will be exponential. The opportunity is exponential from here. So I'm not looking at incremental from 10, 12 moving to 13, 14, 15, but much larger numbers.
Sure. That's very helpful. And second, on inorganic opportunities, could you share some perspective? How are you thinking in terms of location, size of assets, and owned versus managed facilities? And given your own experience, both at Radiant and now at Max, would it be fair to assume that beyond brownfield capacity additions in your current facilities, growth would primarily come from M&A?
No, I think there's tremendous growth, like I said, even within the present network. It is the payer mix is inefficient at present. That is huge opportunity. It's like setting up, imagine 1/3 of my capacity is being used suboptimally. So, when you have the opportunity in turning that up, that's one. Brownfield, we have arguably perhaps the two best access to the two best land banks in Delhi and Bombay, right in the middle of South Delhi and right in the heart of the city in Mumbai as well, which is going to be leading to the brownfield. Other to this, we have the balance sheet, we have the ability, we have a track record and a DNA of doing M&A. We will continue to look at those opportunities. We will acquire. For us, size of assets, it doesn't matter whether it's a chain of hospitals or it's a single hospital. What does matter is the size of that asset. So, we don't typically do 100-bed hospitals, say higher secondary, single specialties, etc. We do large-scale quaternary care. And there are plenty of opportunities from that standpoint. Again, we've been limited by movements have been limited, and claims on our time have been immense on during the entire pandemic. So we really haven't been able to go out there and sort of scrutinize for opportunities. But this will change very, very quickly. And it doesn't take us time to react to acquisition opportunities.
Sure. And lastly, what are the risks you see from being concentrated in Delhi from a regulatory standpoint, and are you looking to expand to other metros?
We are not necessarily only in Delhi. We are in 6 states. When we say Delhi, NCR, we are in Delhi. We are in UP and with Noida, and we are in Gurgaon. So there are advantages to having geographical concentration in cities. And, we would like to create more such clusters that we have in Delhi because, just on a marketing standpoint, from ability to get doctors, brand standpoint, it makes a lot more sense to be concentrated geographically rather than spread out across the country. So, synergies are there if you have a higher density of, and Delhi NCR is the most attractive market, right? I mean, it drains from all of North India, Northeast, Central, 40% of all global medical tourists come to these cities. There's a huge upcountry business, which is not there in most other cities. So, and the best clinical talent perhaps lives in metros. So it is going to be our concerted focus that we look at creating more such clusters that we have in Delhi and continue to build on these clusters as well.
Sure. Thank you. That's very helpful.
Thank you. The next question is from the line of Abhishek Sharma from Jefferies. Please go ahead.
Thanks. Thanks for taking my questions.
Sir, I'm just trying to see the impact of this second wave on your operations, which I believe is not captured in the 4Q results. What are the dynamics of non-COVID occupancy here? So, I mean, when COVID cases rise as sharply as they did, does the non-COVID occupancy does that drop drastically? And now that the COVID cases are coming off, is your COVID occupancy taking time to come back? Just some color on that would be helpful.
So I think, like I mentioned in my opening remarks, of course, there has been a very quick increase in non-COVID in COVID business, which obviously directly has an impact on non-COVID. And therefore you'll have an impact on your RPOB because RPOBs get diluted and you get lesser RPOB from the COVID business. But it sort of gets overcompensated or compensated with the huge amount of occupancies that you're able to obtain during COVID. So that is, and then you also have, like you said, you have a switchover period, which we also seen happens very, very quickly. So we haven't seen occupancies come down dramatically because of COVID going down. Non-COVID also bounces back very, very quickly, or has been doing so as well.
So, like you said, I mean that right now 30% of your beds are dedicated, and they have as of now 60% occupancy. This is the COVID part. The non-COVID 70%. What kind of occupancy would be there right now?
80% plus. I mean, you can see that in the overall presentation as well, right? We've shown an occupancy sheet in the presentation.
So 88% on the till 15th of May on the non-COVID side, and then 92% on the COVID side, till 15th of May.
Got it, sir. Thank you.
Thank you. The next question is from the line of Aditya Khemka from InCred Asset Management. Please go ahead.
Yeah, hi. Thanks for the opportunity. Sir, can you talk a little bit about your unit economics in terms of how so last I remembered, Nanavati was doing low single-digit EBITDA, and can you just talk about how that has been able to ramp up? Also, in the similar lines, can you talk about Max Saket? Is this now the most profitable unit that you have?
Yeah, so Nanavati is this quarter is around 10% of EBITDA margin, and so after the extra cost, so there's obviously a movement there. Yes, Saket happens to be one of the most profitable hospitals. I think more so in quarter 4 because we had shifted a lot of COVID work to Max Smart, and then we are doing the most of the non-COVID work in Saket cluster in that hospital. So that brings up the EBITDA to more than 27%, in Saket in this quarter. But otherwise, I would say all hospitals are, giving positive margins and they're high 20 EBITDA.
Understood. And on the Max Labs front, can we have some sense on, how much revenue of Max Labs is captive present through Max Hospitals, and how much is the network number of laboratories you have? Any color on that side, if you could provide, would be helpful.
So in Max Labs, we don't capture the Max in-house business. It's all third-party business, which is there in Max Labs.
So typically, I think we mentioned this earlier also, typically 11 to 12% of the hospital revenue comes from pathology, all right? And that revenue is captured in the hospital, and these hospitals and these labs are in hospitals also. There's only one reference lab that we have in Saket, and that's what caters to most of the Max Lab business. And the Max Lab business in the quarter 4 was roughly around 18 crores, which is 5 crores of COVID and 13 crores of non-COVID. And on the non-COVID side, so that COVID dropped in quarter 4. So obviously the volume also dropped on the COVID side, for Max Lab. But on the non-COVID side, there's a growth of 20%, 14-15% that you can see in Max Lab. And I think we pressed the figures there in the quarter 1. So they have expanded in a big way, and we do expect that Max Lab should do much better than what they did in quarter 4 going forward.
Right. So just to understand this a little better, so when you classify the lab revenues of the hospitals under the hospital chain, So does Max Labs as an entity get a fee from Max Hospitals for maintaining their labs, or is it like that is something you're doing now, but when you spin it out, you will basically recognize that revenue under Max Labs itself?
So this Max Lab revenue is basically the non-captive revenue. That means it is not in the hospital, it's outside of the hospital.
Understood.
We have the franchisee set up. It is totally non-captive revenue, right?
Understood.
All right?
Understood.
Obviously, the samples come to hospital. It's part of the same entity. As we spin it out, obviously, then there'll be transfer pricing rules, regulation setup that will apply. But as of now, it's part of the whole EBITDA is captured in the hospital. So it's a I would say high teen EBITDA that we're getting in the Max Lab as of now.
But it's a clean arm's length basis. So there's no cross royalty or sort of any support fees they get for the lab or maintaining the lab or anything like that.
I got you, sir. And lastly, if you could spell out the absolute quantum of capex you expect for the next 2-3 years, and what was that number this year?
Well, we mentioned that that we generally spend roughly 2.5% of the top line towards the maintenance capex.
You're talking about maintenance capex, right? Well, what is it?
And the brownfield capex, both put together.
Yeah. So maintenance capex is generally 130-135 crores number that we see in next 2 years on an average. I think this year number was a bit lower. It was roughly around 115 because of the fact that in quarter 1 and quarter 2 we did not spend money. We wanted to conserve cash. And in quarter 4 we actually spent roughly 70 crore rupees on capex. All right. So that means that we have ramped up the routine capex spend during the course of the year. It's peaked in quarter 4. So that is our numbers that we see even going forward.
And on the brownfield side, what capex do you expect over the next 1 or 2 years or 3 years, if you could spell it out?
So we were looking at over a 4 to 5 year period spending about 1,300 crores. 40% of that, let's say about 500 crores, for will go out in the first 2 years. Because usually the capex is back-ended. That's when you buy the equipment and do the finishing and initially you're doing more superstructure, etc. So we can be looking at about 150 crores to 200 crores a year. I think in this current year you probably do about 100 to 150 crores.
So overall put together, your capex maintenance plus this would reach about 300 crores in the region of that, right?
That's right. Yeah.
So that wouldn't require you to take any external debt. You can finance that amount of capex from your current cash flows, correct?
Yeah, we're generating cash. Absolutely. We'll be generating excess cash over and above that.
Over and above that. Yeah, that's fair enough. Thanks a lot for answering my questions, gentlemen, and all the best.
Thank you.
Thank you. The next question is from the line of Hardik Bora from Union Mutual Fund. Please go ahead.
Yeah, thank you for the opportunity and congratulations on a good set of numbers. So my question also was on capex. Just to clarify, you said 135 crore over 2 years, right? Maintenance capex.
Per annum. This is the maintenance capex.
Okay.
Yeah.
Okay. And the operating EBITDA that you have reported for this quarter, despite the change in occupancy, just to clarify, this should be the base, right? From here onwards, as the preferred business volume goes up, the incremental growth in EBITDA should only be positive from here onwards, right? Notwithstanding whatever movement happens on the COVID business.
That's right.
Okay, understood. And just one final question on one of the information given in the presentation on the ROC. So just wanted to clarify my understanding here. The 25.6% ROC, which is annualized for this quarter, the denominator does not include the capital employed from the partner facilities, right?
No, it does. So what it does not include is this whole purchase price, allocation that we did in 1st of June, and as a result, the goodwill has gone up. So you see the number from March 20 to March 21, there's a big increase in goodwill, which is basically the purchase price, allocation that we did, post the merger. But if you don't take that increase in goodwill because of this, PPA, so we have basically taken the capital employed, which is actually invested in the business, not the one which is where all partner facilities or wherever. Yeah, it's total.
Okay. Thank you for clarifying that, and that's all from my side.
Yeah, it's the sum of parts. Yeah.
Thank you. The next question is from the line of Charulata Gaidani from Dalal & Broacha. Please go ahead.
Yeah. My congrats on the good set of numbers. My question is in terms of contribution of oncology in FY21, despite COVID, how have you been able to maintain the contribution at around 20% plus? That is one. And second, with COVID, are you seeing an impact on the receivable cycle, especially from the second wave?
So first and foremost, I think oncology contributions are maintained because that's really one business, and particularly in our case, because we are at the very high end of quaternary care and oncology, that is one business which gets less impacted and it bounces back much faster because of the need to sort of seek clinical solutions to your problem. If you have cancer, you can't really defray it or delay it very long. So this business is more resilient from that standpoint, and like I said, bounces back faster. So that is why you're seeing oncology growing the way it is, and also the contributions as well as revenues being maintained from that. That's one. I think as far as what was the other question that you had? Yeah, so DSO stands at 70 days, at the end of March. So I don't think there's any impact of COVID on the because I think what has happened is with COVID, the share of TPA business or the insurance business has gone up, and that tends to have 45-50 days at best as the DSO. So there's no impact on DSO, because of COVID.
Okay. And
generating cash and we're reporting that amount to you every quarter, so you see there's a consistency in the cash generated from the operations.
Yeah, right. And in terms of international patients, after the second wave, by when do you see it coming back? First to around 10%, 11% levels?
Soon as we know when the flights are going to open up. I think it's totally and entirely dependent on that from our vantage point.
Okay, and which countries?
Sorry.
Yeah, and international patients are from which countries?
We get people from about 65 to 70 countries. Largely from the Middle Eastern cluster, African cluster, Southeast Asia. We get from East European cluster, and many other countries, but these are the large concentration of clusters that we have.
Okay, fine. Thank you. All the best.
Thank you. The next question is from the line of Kitika Gupta from First Voyager Advisors. Please go ahead.
Hi, thanks for the opportunity. Congratulations, Abhay, for the great set of numbers. The first question I have is on the diagnostic business. I understand it's already been launched as a separate subsidiary. So wanted to check what are the kind of ramp-up plans and what should it look like from a 2 to 3 years perspective?
Can you repeat your question, please?
Yeah, the question is the diagnostic business.
Yes.
It's already been launched as a separate subsidiary. So what is the kind of ramp-up plan that you have there from next 2 to 3 years perspective?
So we have, aggressive ramp-up plans, of course. The whole idea of moving it into a separate vertical, into a subsidiary, was that we have greater management focus on this, and it has its own sort of objectives, and it doesn't get obfuscated within the entire hospital network. So that is the first step in doing that. We believe the opportunity is great, particularly in Delhi NCR, where we have a very, very strong brand. So we intend to start with that, and this is where we are, and particularly in COVID times, our brand has leapfrogged even more on the back of RT-PCR tests, etc. Like I explained, we've done 5.5 lakh RT-PCR tests. So those are the number of people whose homes we've been to, the number of people we've sort of served. And going forward, that will help us in touching them for non-COVID related business as well, which in any case has been growing through this phase as we speak. Once we, from here on, we intend to spread ourselves in North India and then look at other parts of the country as well. So the opportunity is large. I can't give you specific guidance on what is the sort of numbers that we're looking at, but we intend to be serious. We're already the third largest business in diagnostics in Delhi NCR. We intend to ramp up serious numbers in this, and that's why we looked at moving into a separate sub. Otherwise, it was, within the folds, we would have been satisfied. We're not. We intend to, be significant players and, we stand up and be counted amongst the larger players in the country going forward.
Okay. I think earlier in the call you mentioned a revenue run rate of 18 crores for the labs business. That I wanted to just check. That's for the fourth quarter, or I'm not sure. I didn't get the number correctly.
Yes, that's fourth quarter. Yes. So I think the quarter 4 number was 25 crores of revenue, which had 30 crores of COVID and 12 crores of non-COVID. The non-COVID obviously has grown and COVID had come back. You know that quarter 4 COVID numbers were down. So the overall number is 18 crores from 25 crores of quarter 3.
Okay, so it's already 100 crore kind of a revenue run rate.
That's right. And this is all third-party business.
Right. And are we also looking at inorganic growth in this? Like any opportunities that we see there for ramping this piece up?
We will be looking at opportunities, for bolt-on acquisitions in the laboratory business as well.
Okay, got it. And the second part I wanted to understand for the hospital business, there also, we've alluded to the fact that, we'll be looking at inorganic opportunities. So just wanted to check, are there any discussions which are on or any pipelines that we should be aware of?
There's always a pipeline and various degrees of conversation, but of course, if there was anything concrete, we would have to inform the exchange. The fact that we haven't done so sort of alludes to the fact that we haven't crossed the Rubicon as far as this is concerned.
Okay, that's it from my side. Thanks.
Thank you.
Thank you. The next question is from the line of Rajiv M from Win Equity Partners. Please go ahead.
Hi, Abhay. Congratulations. We have moved to small cap Morgan Stanley fund just a few days earlier. And I hope in the next 3 years we'll be able to get into the large cap. The easiest and fastest way would be to explore on FSI. The government has allowed extra FSI for all the existing hospitals. So we can expand just where we are in terms of location because that's going to be our initial advantage. Then we can also look at acquiring a lot of hospitals in Bangalore, Hyderabad and Bombay, which are reasonably priced right now in terms of some kind of a strategic alliance. And also do some extra efforts in data mining, CRO activities where we can get huge set of numbers over a period of time and valuation also. And then you can spin off the 3 companies to separately. One is medical, the other can be data, and the third can be your diagnostic. Please comment.
No, I'm happy to consider all that you're saying and move in those directions. Thank you for the advice.
Thank you.
Thank you. We move to the next question. The next question is from the line of Amit Deshpande, who's an individual investor. Please go ahead. Mr. Amit Deshpande, you may go ahead with the question. There seems to be no response from the line of Mr. Amit Deshpande. We move to the next question. The next question is from the line of Shaleen Kumar from UBS. Please go ahead.
Yeah, hi. Thanks again, and apologies for last time. My line got dropped off. So, Abhi, just on Nanavati, you had some plan for VRS and all, so that you can improve the margins. So, should we expect that to happen? Now, many other things are behind us in terms of restructuring, capital raise, and all.
Yes, so we expect that to happen. We seem to keep getting really delayed over there because of the pandemic. We're just now, off the second wave, so you'll see further traction in this, and we hope to complete it within the year.
Any idea of what would be the size of that?
Sorry?
What would be the size?
Size, from our standpoint, there isn't really a size. It really depends on how many people sort of come up to volunteer. We may be doing it in batches. The total exercise should not be more than 50-75 crores. But what the actual uptake is going to be will be dependent on number of people who come in and for the voluntary retirement.
Right. Again, on the brownfield expansion, you might have mentioned that, and I might have missed because of my line. Is there any delay because of the COVID, etc.? What are the timelines, when we can see the brownfield expansion to start adding up in terms of the capacity?
So there has been a slight delay. We were looking at, commencing in the first quarter. We will be looking at doing so in the second quarter now. So there has been maybe a 2-3 month delay in this whole thing because, all of a sudden, all offices were closed, government offices, as you're aware, and, on the second wave. So, but it's, the good part is the second wave came and it's gone. It's just been a couple of months. So, it's delayed us by that much and no more.
Understood. Also, in terms of COVID occupancy, yes, I can see that you have given occupancy increase and decline in the cases. Is there a material change in the COVID occupancy in past 15 days?
Oh, yes. No, there has been a material change in COVID occupancy. It is going up, as COVID is coming down. So, and this time around, we believe the bounce back perhaps will be faster than previously.
Understood. Okay. I have 2 bookkeeping question. In terms of ESOPs, what kind of ESOP expense should be built in going forward?
What is it? In terms of ESOP expenses, what is the sort of expenses they should be looking at hitting on the way forward? Similar amount. Similar amount of next year. Sure. This is a equity settled scheme, so there's no cash outflow there. Mm-hmm. And so what we expense that adds to the other equity, in the balance sheet. So it's no impact on, that way. But in terms of, charge to the P&L, you'll see the similar charge in November, and then the charge will come down.
Okay. And lastly, again, on your inorganic growth front, is there any thought process on the side? You're open to, obviously you have proven right now, by integrating into Max, taking over much bigger players compared to, from the driving.
You'll have to repeat that question again. You're breaking off a little bit.
I'm really sorry for that. And so just want to pick your mind on inorganic growth opportunities. So, are you looking for a full-fledged, buying out opportunity, or you prefer more of a?
I like both. So it's not either or, and so we are almost all the time in conversations with respect to both, and it doesn't have to be either or.
Okay. That's it from my side. Thank you so much.
Thank you very much. That was the last question in queue. I would now like to hand the conference back to the management team for closing comments.
So thank you all for making the time to be on this call. I hope we have been able to satisfy your queries and answer your questions. We try to do it to the best of our abilities, keeping in mind forward-looking statements and so on that we have to be careful about. So I wish you safety and wish you all the best. Thank you very much.
Thank you very much. On behalf of Max Healthcare, that concludes the conference. Thank you for joining us, ladies and gentlemen. You may now disconnect your lines.